Good afternoon. Good afternoon, everybody. This is Ahmed Mamdouh, Financial Markets Analyst at FXGate. Today's webinar is going to be on a trending issue, which is the impact of the coronavirus on financial markets and how can we take advantage of the volatility currently occurring in financial markets to find good investment opportunities. So this is, as we can see, this is the title. Now let's start. Can you hear me well? Okay, let's start. Now we can, first of all, we need to know that we can like say that there are currently 5 stages of the COVID-19 outbreak. The first stage was the spark in Wuhan, China, where the first coronavirus case appeared in Wuhan on December 16. That's according to the latest data. This is actually, until this stage, it was something like, it was just a domestic problem. Then it started to spread more inside China. But still people worldwide were seeing it as an epidemic inside China, and it's not something that can hit the whole world. But thereafter happened a rapid spread all over the world. So this is the second stage. Things appear to be serious, but actually we can say that the third stage was the most important, which occurred after the WHO declaration of COVID-19 as a global pandemic. Why this stage is very important? Actually, this stage was very important because after the WHO declaration, governments all over the world started to take political and economic actions, which are like some governments all over the world started announcing stimulus measures to help their economies. And the most famous, as we know right now, the quarantines and the lockdowns. Actually, the quarantines and lockdowns were very critical and are still very critical in the fourth stage, because it means that there were several shutdowns in businesses, especially the services sector, like tourism, restaurants, and various sectors were hit hard from the quarantines and the lockdowns. So actually this, we can say that the quarantines and the lockdowns are key issues, key challenges facing now global economies, and they will for sure have strong damages on the world economy. The final stage, or let's say the fifth stage, which is actually just in China, it's not worldwide, is flattening the curve. As we can heard over the last couple of weeks, that the curve in China is flattening, which means that the new cases added are now increasing at a mild range, and as we can see, it's like stable. So now the peak is over and the curve is flat, and it's starting to decrease. But actually this stage is only in China. Over the past 3 days, we have seen also some, let's say, slowdown in the infection cases and the death rates, especially in Europe. But still, we can say that the curve is flat. We can only say that the curve is flattening in China. Any questions? Hello, can you hear me well? Okay, let's move to the now let's move to the important part related to the markets, and we mean financial markets. What is volatility? we now hear that there is high volatility in markets after the rapid spread of the coronavirus. But what actually is volatility? As a definition, we can say that volatility is the amount of uncertainty or risk related to the size of changes in a security's value. But actually, this means that the price of a certain stock, for instance, can change dramatically in a very short period. But the word volatility could go either way. It means that that the fluctuation or the volatility can occur in both directions. So the stock price can increase or decrease, or increase and decrease in a very short time period. But actually, what occurred in market after the panic was the worrying volatility, which means that traders started to sell off all their equities and try to avoid the losses by selling all the equities they have, and try to get as much cash as possible. How can we measure volatility? Actually, one of the key measures of volatility is known as the VIX, which actually represents the market's expectations of the 30-day forward-looking volatility using price inputs of the S&P 500 index options. The volatility index, or the VIX, represents the market's expectations for the coming 30 days. So as the VIX increases or rises, this means that the market is going to suffer from high volatility, and the VIX gets its inputs from the S&P index options, and the S&P is perhaps the most famous, or the one of the most famous stock indices in the United States. Let's look at this chart. In this chart, we can see that we have the S&P, which is in blue, and we have the VIX. As we can notice here, that the VIX, as we can see here, with the beginning of 2020, it started to increase gradually until it shot up and reached a record high above 80. It was like 86. And this is one of the highest on records, which actually indicates that the market is suffering from very high volatility that occurred after the spread of the coronavirus. After the spread of the coronavirus worldwide and in the United States specifically. So one of the measures that can, as we can said, one of the measures of measuring volatility is the VIX, and here we can see the impact of the coronavirus on the index. Any questions so far? Oh yes, someone is asking about the VIX. Is it a number or percentage? No, it's number. It's not a percentage. Just it depends on number. So 10, 20, 30. Actually, the average, as we can see, that the average for the VIX, it's always below 30. Its average is between like 14 and 14, 20, between 14 and 25. So actually, it's not a percentage, it's an index depending on a number. And as we mentioned, it gets its inputs from the S&P 500. Okay, any questions? So now let's continue to see what is the impact of the coronavirus on stocks. Since we mentioned stocks, actually the first thing that occurred is that, as we said, that investors and traders started to sell off all or most of their equities to seek cash and to avoid more losses. And actually, we saw a dramatic fall in global shares, like as we can see here. For the Dow Jones, for example, as we can see here, in this chart, we can see the largest one-day drops that occurred in the history of the Dow Jones Industrial Average. As we can notice here that the two bars in red were on March. The first one, which is one of the largest one-day drops, occurred on March 12th. And just after 4 days, a stronger fall happened in or on March 16. Actually, this shows that the sell-off and the panic was very strong, and that investors preferred to, as we can see here in the title, prefer to activate the risk-off mode, which means that whenever you have anything risky at your disposal, you sell it and try to seek safety try to buy some safe haven assets, or at least get cash and avoid trading and sell off any risky asset to avoid more losses. So actually, the first thing that occurred is sharp sell-offs in among all global equities. Global shares, why, as we mentioned, so accordingly, global shares wiped out about $15 trillion. Actually, this is one of the strongest losses in the history of global shares. This is a historic loss that occurred only during the first quarter of 2020. As we mentioned, that the markets wiped out a massive $15 trillion. The Dow Jones, for instance, lost 23.2%. This is actually one of the strongest falls since 1987, and the S&P 500 actually fell more than 20%. Actually, what added to concerns is what happened in the oil market, as oil dropped more than 60% due to a conflict between Saudi Arabia and Russia regarding output cuts, and actually due to the weakening demand that naturally occurred with the slowdown in economic activities in all major economies and all oil importers. So actually, we have witnessed a very sharp fall in oil prices. That's actually more than 60% during the first quarter. What was the effect of the oil slump? Actually, the effect of the oil slump, it had a very strong impact on global equities, since as we know that we have energy shares, or companies working in the energy and oil sector. So actually, the tremendous fall in the oil affected all the energy shares and actually caused more panic in markets. Any questions? Now let's move to the second stage. As we said, in the first stage, we saw a sell-off. So investors, after selling off some of their equities, some investors preferred to resort to safe havens, more specifically classic safe havens. So here is a comparison between gold and bonds. As we can see here, the chart on the left, this is the gold on the monthly chart. As we can notice here that this is the month of January, and this is February, and this is March, and this is April. As we can notice here that over the first quarter, gold managed to lock some gains, actually like near 4% increase over the first 3 months of 2020. But actually, as we can see here, that there was a very, very strong volatility, especially in February and March. Look at the candle of March. Look at the difference between the high and the low. That's very huge. Actually, this reflects the strong volatility that occurred in markets during the first quarter. But actually, at the end of the day, some investors at least managed to avoid losses by buying gold, and as we said, over the first quarter, gold managed to advance like nearly 4%. However, on the other hand, if we compare with the US 10-year bond yield, and actually there is an inverse relation between the bond price and the yield, or the return on this bond. So as the yield dropped, this means that there was very high demand on bonds. And bonds actually is one of the most safe, or let's say it's the safest safe haven asset. So as we can see here is the January, here is February, and here's March. This is a monthly chart for the US 10-year Treasury yield. The 3 months in yellow, as we can see here, the 3 months in yellow actually represent the tremendous fall that occurred in the yield on the US Treasuries, which actually exceeded 60% over the first quarter, which means that more people, due to the strong panic in markets, decided to put their money in bonds, which actually means lending the US government for this return, for this very low return, but just seeking safety in bonds. So this is actually represent the amount of panic, as we said, we have witnessed, like we saw a 60% drop in the yield of the US 10-year Treasury bond, and even more in even the 1 month and the 3 month treasury notes or bonds in the United States recorded negative yields. And this actually means that investors or traders were ready to accept lower than the amount they deposited at the time of maturity due to the strong panic in market. Any questions? Okay, after seeing that, now we have noticed the impact on the global shares and the impact on some of the safe havens, which are actually the classic safe havens, which are the gold and bonds. But actually, something else occurred, which is seeking cash. Many people at this stage decided that, no, I'm not going to put my money in some of the safe havens. All I want right now is cash, which means they are trying. Yeah, you can see a question here. Can you send the whole PDF as is having good knowledge? Okay, we will send at the end the presentation for the attendees. Okay, cash is king, which means that as we said, that some traders decided, no, I'm not going to put my money in safe havens. I'm going to, the best thing right now is to have cash in my hands. See cash because especially actually some traders had to cover the large market positions on borrowed money. As we know that in trading, especially in Forex, you can have trade on leverage, and you can borrow money from the broker to invest more. So when a loss occur, the best thing is to have cash to pay back all to pay back or to cover large of the losses and pay back the borrower. Okay, as we know also that that the corporations, as we can see that also some of the companies also prefer to have cash because they want to have enough cash in their hands to pay for their employees and to be ready for anything that could occur in the coming period. Also in the healthcare sector, we noticed that some hospitals also rushed for cash in order to be able to buy equipment needed to deal with the COVID-19 outbreak. And actually, we noticed that it was not just cash. Many people preferred to have US dollars, specifically since the US dollar is actually the world's reserve currency, and it is considered the one of the safest, or many people always consider that gold and dollar are the most safe havens. Actually, there are some classic safe havens like the Japanese yen or the Swiss franc, but we noticed that when there was a very strong panic in the market, many people preferred to buy US dollars or to have their cash in US dollars. Now let's see the impact on the US dollar. Actually, this resulted in, as we can see here, this is a monthly chart starting from 2020. So we can track the impact of the COVID-19 outbreak on the dollar index. The dollar index measures the movements of the dollar versus 6 major currencies. So as we can see here that the dollar index saw an increase over the first 3 months of the year, and actually also in April it is still signaling some increase, as we can see here. So as we mentioned, that the dollar index is one of the actually one of the safest currencies during panics. So many people decided to buy either gold or the dollar. Any questions? Historically, the dollar index has been one of the most important safe havens. If we make a flashback to the financial crisis during the 2008 financial crisis, we can notice that what happened during the financial crisis is that the dollar started to retreat at the very beginning, then it stabilized, then it started to increase. But actually, during the financial crisis, other safe havens like the Japanese yen or the Swiss franc were having more demand than the US dollar. But this time the situation is different. We can find that the dollar is gaining more haven demand, and actually this has been occurring since the presidency of Donald Trump. The dollar has been gaining more haven demand during hard times, especially during the trade war between China and the United States. But actually, what happened after the Fed measures? The Federal Reserve decided to intervene and announced several stimulus packages and several measures to help the US economy to deal with the negative consequences of the outbreak of the COVID-19. Also, the US administration announced a massive 2 trillion massive stimulus to help the US economy. So actually, after the the Federal Reserve's measures or monetary measures, we found that the dollar index snapped some of its gains to finish the first quarter on a 2.6% gain instead of 6.7% gain, which actually occurred during March, but then it snapped some of the gains to finish at 2.6% gain. And actually this happened because of the Fed's broadened measures that allowed several foreign central banks around the world to have access to US dollars. So actually this reduced the panic in the market, and the central banks were having now we're having less panic because now the Fed will provide them with the needed US dollars they need. So actually this, like we can say, reduced the liquidity panic, and actually forced the dollar index to snap some of its gains over the first quarter. Any questions? Okay. So the key question right now, what shall I do right now? What if I'm going to invest my money, or I want to put my money in something? Actually, as we mentioned that one of the best options or the safest is to buy gold. Historically, gold is known for its safe haven merits, and it's known also as a store of value. Also, the gold ounce is priced in US dollars. So whenever you buy an ounce, so you are having a dollar value in it. So it's one of the, as we said, is one of the safest options. And actually, many businessmen who bought gold early, like at the end of January, are now or actually managed to avoid any losses, and also generated some gains. So so as we can say that gold is still one of the best options, and it is expected to resume its increase, because as we mentioned that we are still having new cases every day. We are still having a rise in the death toll from the COVID-19. So as long as there are fears in markets, we are expecting to have high haven demand on gold. Also, as investors track the impact of the COVID-19 on the global economy, one of the latest expectations by the OECD refer that the global economic output is expected to drop between 20 and 25%. Also, as we can notice that over the past few weeks, we noticed that the data coming out from major economies, whether from the United States or any European economy, we can notice that we have witnessed a very downbeat economic data, showing the extent of damage on the global economy, especially the services sector and the labor market. For instance, we show that one of the most recent data from the United States tracking the impact on the labor market showed that 6.6 million American citizens applied for the jobless benefits last week. So actually, this is a historical number, a very high number, showing the extent of damage on the labor market. We saw also that American employers shed or terminated like 171,000 jobs over the course of March. So as long as we're having downbeat data, as long as we are having negative expectations for the global economic outlook, safety demand is expected to increase. So gold prices may still go higher. However, on the downside, we are having some countries decided, like Russia, decided to stop its gold imports starting from April 1. But actually, we are having another thing on the supply side that may also help gold to resume its increase, which is actually at the meantime, as we know that gold is mainly shipped through commercial flights. So at the meantime, we are having suspension in flights. Many flights now are suspended, and many countries are currently closing their borders. So we may, and also for miners are also, gold miners are also having some difficulties in gold mining. So on the supply side, the gold shortage in the coming period may keep balance between supply and demand, and this could eventually lead to higher prices in the near future. Let's see this chart. This is a monthly chart for gold. This is the performance of gold over the first 3 months of this year, and this is April. As we can notice here that that gold has been moving in a bullish direction. As we can see here, it's moving in an upside direction, and it is expected to it still has a good chance to resume its rally. Any questions? Okay, let's move on. As we mentioned that while gold still has a good chance to rise further in the coming period, some traders may prefer to take advantage of the current panic and to have a very good, let's say, medium or long-term investment by buying in the share, by buying in stocks or the share market. So actually investing in shares, as we said, is risky, but it can generate more return. And as we know that the general rule is that the more risk, more return. So one of the best options right now is buying in China A shares or the Chinese yuan. What is the China A shares? Actually, China A shares are the domestic shares sold or open for trading inside China, inside the mainland China. You can find them in two exchanges, the Shanghai Stock Exchange, which is the SSE, and the Shenzhen Stock Exchange. Actually, this more related to domestic shares, mainly priced in the Chinese yuan and less affected by the global economic downturn. So one of the best options right now, since as we mentioned that China now is managed to flatten the curve, so it's likely that China will have faster recovery than the rest of the world. So now the domestic shares in China offer a very good investment opportunity, especially if we look here at the Shenzhen Stock Exchange composite overview. We can notice that this is the monthly chart. We can notice that compared to the losses incurred in the US stocks, we can notice here that there was less damage from the COVID-19 outbreak. Mainly the prices were moving in the same level. So now the market is offering a very good chance that the price may increase in the coming period. Also, some investors or currency traders see that the Chinese yuan could offer a very good investment chance, since it is expected to become one of the most important reserve currencies in the near future. However, before investing in shares or deciding to take a step into the stock market, as we said, now investors or traders have a very good chance to add cheap and high quality undervalued stocks to their trading portfolio. Now, as after the dramatic fall in the price of shares, we can notice that now many or several stocks are now being undervalued, which actually offer very good chance to buy one of the undervalued stocks, especially if the company is having a very good fundamental perspective, and if it is less affected by the coronavirus damage, so some companies are or some sectors, let's say some sectors, are expected to recover faster than other sectors. This graph actually shows shows some of the potential winners and losers after the COVID-19 outbreak. So as we can notice here that one of the most negatively affected sectors, tourism, aviation, the automotive sectors, the education. But on the other hand, we can find that there are some potential winners from the COVID-19 outbreak. E-commerce, like anything related to the e-commerce, the food processing and retail, of course, the medical sector and the medical services. So buying shares in one of the winning sectors, having an undervalued price at the meantime, actually is a very good idea, and can generate a very good return on investment in the near future. Actually, some of the companies also located in the losers part can also increase in the near future after full recovery from the coronavirus, but actually buying them now will take a very long time until they reach full recovery. So what is the recovery time? So it is very important, since we are speaking about the stocks, is to know how long it would take for the stocks to recover after downturns or fallouts. So let's track the impact on the US stocks, or the Dow Jones specifically. Here we have three of the market crashes. The first one is the 1987 Black Monday, and the 2001, the 2002 9/11 attacks, and the third one is the 2007, the 2008 financial crisis. During the first accident, which actually known as the Black Monday, that occurred in 1987, stocks tumbled 36%. It took 2 months of decline to record 36% decrease. However, this is the impact of the Black Monday, as we can see here in red. But the recovery time, as we can notice here, that the recovery time it took 22 months to recover from the damage caused by the Black Monday. Moving to the 2001-2002 downturn, we can notice here that it took 33 months of decline, as we can see here in red, and the recovery actually took 48 months to reach the peak or the peak once again, or the same point that the price fell from. It took 48 months. The same thing for the 2007-2008. It also took 48 months, which actually is the same as what happened in 2001-2002. So during the financial crisis, stocks continued to fall for 17 months, falling 54%, and then it took 48 months to fully recover from the fall, as we can see here. So actually this is a very long time. So you will have to wait for 48 months. Actually, this is a very long time. This is actually calculating the trading days, could be more than 4 years or more. So, but actually we have to take into consideration that this is the key index, but some shares inside the index can rise more and can recover faster. So investors have to try to pick as we said, try to pick the shares that are currently undervalued and offering having very good fundamentals, and try to buy it at the correct time, and to have the highest return on investment. Any questions? Okay, let's move to the next slide. Here is, since we were talking about the stocks and investing in stock markets, oh yes, here's an answer to the question. Someone is asking why, despite the bull run, there are huge corrections. Actually, as we can see here, when we track the when we have been tracking the impact of the coronavirus on the S&P 500, we can notice here that the market is falling here, forming a bottom. Then we can see some recovery, then forming another bottom, then recovery, then bottom, then recovery, then bottom, then recovery. Then we can see here another bottom. So actually, this is the natural thing that mainly occur during panics, is that we see more than a bottom then recovery, a bottom then recovery. This is actually a natural behavior because of the selling positions. Some people are selling their stocks at a certain price, and others are demanding at a certain price. So we witness ups and downs. So, but whenever the sell-off or the selling pressure is higher, the market tends to put a bottom. Also, there's something psychologically when a market sets a bottom. Investors may feel that, oh, perhaps this is the last bottom, so it's a very good time to buy right now. So we see a mild recovery like the one we are seeing here. But as the panic continues, like in the current situation, we are seeing a dramatic increase in the number of coronavirus infections, and the panic, and as the panic increased, so the sell-off strengthens, causing another or performing another bottom. Then we see a slight recovery, then another bottom. So this is a natural behavior that mainly occurs during panics. And many investors or traders are always having hope that, oh, this bottom, maybe it's the last bottom, and after that we are going to witness a very strong recovery. So some people decide to buy like from here. Some people start to decide to buy like from here on hope that this could be the market bottom that we are going to generate very high revenues from. So that's why we see several bottoms during panics, on hope that this could be the last bottom. And as we said, some stocks are offered at very cheap prices. So actually, at each stage, some people prefer to buy. Some people say, yeah, this stock is very good, and I'm going to buy at this price. This price is very convenient for me, and but actually, all people are seeking the last bottom. How can we detect the last bottom? Actually, first of all, or frankly speaking, detecting the last bottom, or the bottom that after which the market will start to recover, and there will be no near bottom after it. Actually, this is very hard. It's very, very difficult to set or to find, figure out the last bottom. But actually, there are some things that can help in determining the market bottom. Actually, we can look at the historical price. As we see in the S&P, we have to analyze the behavior of a certain stock or an index when it is subject to panics. So as we said, when we reverted back to the 1987 Black Monday or the financial crisis, we have to analyze the price behavior of the index or a certain stock during crisis, such that we can expect from where the market can rebound. We can use some indicators, especially technical indicators, to decide the best places to buy from. Also, one of the most important indicators to look at are the trading volume, or the volume indicators. Whenever we start to see an increase in the trading volume, this could be the end of the bottom or a start of rebound or recovery. The same thing occur for the volatility. Whenever the volatility decreases, this could be an end. This could be the end of the bottom and the start of recovery. Also, investors and traders have to carefully watch economic data. Actually, economic data reflect the economic situation in a certain country. So keeping eyes on economic data is very important to know how the economy is reacting after the damage. So whenever we see improvement in the economic data, this could be also give a sign that the market could start to rebound soon. Any questions? Okay, let's move on. So now we have, let's speak about the current situation, which is the outbreak of the COVID-19. Actually, there are several factors we have to watch or to take into consideration. The first thing is the flattening curve. Actually, here I'm talking about the curve of the coronavirus infections and deaths. So as we said, that China managed to flatten its curve, or to have a slight or let's say a mild increase in the coronavirus cases, and some sort of stability, and the peak is it has left its the peak. So now the curve is flattening in China, and that's why we said that Chinese shares, or even buying the Chinese yuan, could offer a very good investment opportunity. But actually, this is still not the case in many other economies, especially the United States and Europe. So we have to keep watching the cases of coronavirus cases. Whenever the curve starts to flatten, or we are having lower new cases every day, this could be a sign of the start of recovery, and this could be a good point to enter the market. Also, one of the key points is the time of exiting quarantines and lockdowns. Actually, as we said, the quarantines and lockdowns are causing a dramatic damage, economic damage on major economies. So actually, when governments around the world decide that there will be no longer quarantines and lockdowns, and it's time to go back to work, this actually could be a very good indicator that the market is about to recover. We have also to follow any announcements or any news regarding finding a treatment for the COVID-19 and or any actually in the recent period we have heard about many treatments, but actually we need to have more assessment on each treatment and its efficiency because if there is a very good or very efficient treatment, this also could be a very good indicator and could be a good sign of recovery. But actually the most important than the treatment actually is the vaccine, because finding a vaccine for the COVID-19 is going to be a focal point for the markets, because it will regain confidence. People will know. Let's say that people will not be may remain like worried until the announcement of a vaccine. So actually, we have to, for traders and investors, we have to be watching these four factors. Market have a lot of severe moments these days. Is it safe to trade during these days? Actually, as we said, now we are having very sharp volatility in the markets meantime. So someone is asking whether it's safe to trade at the meantime or not. As we said, we can trade, but it depends on what asset that you are trading in. As we said, there are some safe assets like gold, and also we are having now some cheap stocks. So, but I actually prefer not to trade on the short term. Meantime, the market is offering good investment opportunities, not trading opportunities. So it's better now to buy. As we said, we have cheap stocks. We can buy gold or other precious metals such as platinum, palladium, or silver, but not to trade. Actually, investment is better option now. So you have to it's better now to have a long-term investment, but trading at the meantime, you have to be very careful, because the market volatility is still very high, and it's not safe to have trading like before. Uh, since we are talking about trading or investing, actually there are key strategies that we can adopt during uncertainties or during times of market uncertainty. The first thing is to go gradual and diversify. Actually, you can divide your money like into three parts. Because as we mentioned, that the market may form more than a bottom. So you can, whenever the market forms a bottom, you can, and you find there is a very good chance to buy, you can buy. Then if the market formed another bottom, you can buy again. If the market formed another bottom, you can buy again. Or if you found that the market is about to recover, you can add more money gradually. So you don't have to put all your money at one time, because this is very risky. So you can divide your money. The second thing is to diversify your portfolio, like buying equities, buying bonds, holding some cash, buying gold. Try, as we mentioned, try to focus on different sectors, and you can buy also in different regions. If you can buy in the like in China, US, Europe, or also in emerging markets. So as more as you diversify your portfolio, you are lowering your risk. So it's the portfolio diversification actually is very important at this stage. And as we mentioned now, that it's better to act now as a long-term investor. So you put your money in, let's say in equities and gold equities, and then wait for a long period. Some investors whoever now decide to enter the market, they can buy now and wait, for example, until the end of the year. Then they can assess the situation at the end of the year, whether it's the right time to sell and to sell and liquidate my money again, and to assess the amount of gains at the end of the year. Actually, this could be, in my opinion, this is a better option than having a short-term trading. Any questions? Actually, that's it. So I'm ready for questions if anyone is having any question. Someone is asking about gold is having huge corrections despite the presence of fears. Yes, this is actually a very good question. When we're talking about gold, actually the general sentiment now is predominated by volatility, and one of the key factors actually affecting gold is the dollar. The strength of the dollar, and the dollar playing the role of safe haven, actually managed to get to attract some investors. And as we said, that many people, especially at the very beginning of the panic, preferred to have cash in US dollars. So actually, there was a preference between having dollars or buying gold. That's actually I think this is the one of the key factors, or one of the key factors that caused a huge volatility in the price of gold, and prevented it from taking advantage from safety demand. And actually, at the very beginning, if we assess the behavior of investors and the traders, we can notice that the whole market was moving in the same direction. We were having a sell-off in stocks. We're having sell-off in gold. We were having a sell-off even in people investing in cryptocurrencies like the Bitcoin. So people were actually liquidating. They were seeking cash in US dollars, and the dollar was taking advantage, as we see. So actually, but this did not prevent gold from having some gains over the first quarter, and now I'm seeing that gold still has chance to go higher. So what else? Let's see. Other questions? Do you think the volume will get low? I guess someone is asking about the trading volume. Actually, the trading volume is more important in the stock market. It's not that important in the forex market. So someone is asking that whether the volume will get low. Actually, lower volume means that we are still going to witness higher volatility, or the market still is about to form another bottom. So actually, I think maybe I think there could be another bottom. There could be. I think there still, but there was like some hopes over the past 3 days that the new cases of coronavirus infections are starting to slow down a little bit, or let's say stabilize or slow down a little bit. So this is a good sign, and perhaps the bottom now we are having at the meantime, maybe it's the last one, but still we cannot judge. There could be another bottom after it. I think there could be another one. Also, let's check whether to see anyone having any question now. Can you send me the whole PDF? Can I get recording the webinar? Yes, sure. Well, someone is asking about what is the relation with the cryptocurrency sharp downside move. Yeah, someone is asking about the cryptocurrency, why it failed to take advantage of the sell-off or mess in the market. Actually, the cryptocurrencies, or more specifically the Bitcoin, many people have been talking about the Bitcoin as being the digital gold and its safe haven asset, but actually while it in some situations it managed to act as a refuge, it failed in many other situations. So still, I think the market size of the cryptocurrencies is not large enough. It's not like the gold market or the stock market. It's still having it's also there is the fundamentals of the cryptocurrencies are still not strong as the stock markets or the forex markets. So the link between markets is still not that strong. Um, Also, maybe it will take longer time for the Bitcoin and other cryptocurrencies to have a link with other markets and to prove themselves as safe havens during the times of panic. But actually, if we compare the movements of Bitcoin and other cryptocurrencies compared to gold, like for instance, we said that gold during the first quarter increased about 4%. The Bitcoin dropped like 10%, but actually the 10% is much lower than the drop in the Dow Jones and the S&P, as both of them fell more than 20%. So let's say that it's still we cannot still define the Bitcoin and cryptocurrencies as refuges or safe havens, because also some people are still categorizing them as something related to technology or the technology stocks. So some people are still relating them to technology stocks. So they are actually, I think now they are having something in between. So they are not safe havens and they are not risky assets. I think they are something in between. And as we said, by time, I think over years, cryptocurrencies and Bitcoin can have stronger linkage with the stock and the forex markets. Mhm. Okay, any questions on? Any questions before we finish? Okay, thank you so much. I will be waiting for your feedback, and we will meet in upcoming webinars. Thank you so much, and goodbye.